Hey guys, what's up? I'm Erin and welcome back to the channel. Most people think retirement is about hitting a certain age, usually 65. But the truth is, retirement has nothing to do with a certain birthday. Generally, it has more to do with a variety of factors that many people never even consider. In this video, we're breaking down the real drivers: savings rate, investment growth, spending level, and how they can shift your retirement date by 5, 10, or even 15 years. The early retirement path. What actually makes it possible? Let's talk about the people who seem to be on the fast track, those pursuing an early retirement. Maybe those in the FIRE crowd, financial independence, retire early. Or for those who reach work optional status very early on in their career. And spoiler alert, it's almost never because they earned millions of dollars. Number 1. A high savings rate, not a high income. The research is clear. Vanguard's How America Saves report shows the average American saves about 11.7% of their income. But early retirees, they look very different. According to Vanguard, early retirees tend to be in the top quartile of savers, consistently saving 22% or more for years. Many are saving 20 or 30% of their income. Some are saving an even higher percentage. And they do this steadily, not sporadically. And here's the crazy part. Two people with the exact same income, but one saving 10% of their income and the other saving 25% of their income, could end up with retirement timelines that are differing by nearly a decade. That's the power of a savings rate. It's really your superpower. And truly, your savings rate is more influential and a bigger predictor of an early retirement than income. When you increase your savings rate, two things happen simultaneously, and this is why it's so powerful. First, you reduce your lifestyle costs today, so that means you're going to need less money to support the same lifestyle once you reach retirement. Second, you're putting more money to work earlier, allowing compounding to accelerate your timeline dramatically. It's a double effect. You lower your spending needs and you accelerate compounding. Let me show you what this looks like using some real numbers. Let's say you earn $65,000 a year. If you save 10%, 15%, or 20%, here's how much of your lifestyle your portfolio must replace. After factoring in a conservative $20,000 a year from Social Security, assuming you're willing to use a 4.7% withdrawal rate, here are the portfolios you would need to sustain each respective level of spending. With a 10% savings rate, that means you have a higher spending rate, you would need a portfolio of about $820,000. With a 15% savings rate, you need a portfolio of about $750,000. And with a 20% savings rate, again, this is going to be your lowest spending rate because you have a higher savings percentage, you need a portfolio of about $681,000. Now the question becomes, based on each respective savings rate, how long would it take to build up each of those portfolios? Assuming we could capture a 7% annualized rate of return, saving 10% a year, it would take you about 34 years. 15%, 28 to 29 years. With a 20% savings rate, just 23 to 24 years. If you started saving at the age of 30 with a 10% savings rate, you'd hit financial independence around 64. With a 20% savings rate, it'd be closer to 53 or 54. That's why your savings rate is such a powerful driver of your retirement timeline. Importantly, even if the math says you're close to being financially independent at 53 or 54, you still likely can't fully retire at those ages if your plan depends on Social Security, as it does in our examples here, because we have a gap, 8 to 9 years until early Social Security benefits at 62, or 13 to 14 years until full retirement age benefits at 67. That's a long time to entirely fund your spending from your portfolio. But this is why retirees build a bridge bucket. But here's the thing. If you continue saving 20% of your income past the age of 53 or 54, and you already have a robust portfolio, your portfolio is going to grow fast. Every year you continue to work, the number of years in that gap starts to shrink. And then when we rerun the math using a 4.7% withdrawal rate on the crossover point of when your portfolio can cover the gap years, that bridge part of your bucket, and then support you throughout the retirement once Social Security kicks in, we see that you could truly step away from the workforce around the age of 59 or 60. A 20% savings rate doesn't just get you to financial independence earlier. Realistically, it can allow you to step away from the workforce 5 to 7, maybe even up to 10 years earlier than someone who's saving just 10% of their income. Put another way, in this situation, an extra $6,500 per year put into investments buys you nearly 8 years of freedom, the ability to retire at 59 versus 66 or 67 and maintain a constant level of spending. That's the magic of increasing your savings rate. It shortens the amount of time you need to work, it lowers the lifestyle your portfolio has to support, and it really accelerates your compounding. Number 2, you need to invest for growth, not just safety. Your asset allocation, the mix of stocks and bonds that you choose, also determines how quickly your savings will grow. Because when you choose an asset allocation, you're not just choosing a risk tolerance, you're also choosing a long-term growth rate. That growth rate can accelerate or delay your retirement by years. Let me show you what I mean. Imagine you're investing $12,000 a year for 35 years. Here's how the numbers play out depending on your investing mix. Let's say you have a heavy growth portfolio, something like 90% stocks and 10% bonds, earning about 8% over long stretches. You end up with over $2 million. In a more balanced 60-40 portfolio, earning around 6% over long periods, you finish with about $1.34 million. And on a conservative 40-60 portfolio, earning about 4%, you end up closer to $880,000. All the same contributions, the same level of discipline, but entirely different outcomes. And when we compare the aggressive portfolio to the conservative portfolio, there's more than $1 million difference between the two. That's the power of long-term returns. And even the difference between a couple percentage points going from 6% to 8% can have a massive difference. We're literally talking about hundreds of thousands of dollars, which can either extend or reduce your retirement timeline dramatically. This is why early retirees often rely on growth for most of their journey, not recklessly but intentionally. They understand that if you're saving diligently, the long-term return on your money itself is what's driving your portfolio growth and what's going to get you to retirement or financial freedom quicker. It's just simple math. The slower your compounding engine runs, the more years you're going to need to hit your number. And of course, this certainly doesn't mean that everybody should be investing in a portfolio to capture the high of high returns, or a portfolio that has a 90% stock exposure. For instance, some